Yeah, welcome to financial management class. This is module 7, where we'll be discussing on capital structure decisions. We will explore how firms balance debt and equity to optimize financing costs, and also understand the theories, leverage, risk, and factors shaping cost of capital. And when we talk about the capital structure, what do we mean? And that's very important to understand before we move forward. Capital structure is the mix of various sources of long-term funds used by a firm to finance its operation and investment. And when we talk about this, we have two major sources where a firm finances its operation and investment, and this is through equity capital and debt capital. Talking about equity capital, they are the likes of common and preferred shares. And for debt capital, we have a short-term and long-term borrowings that stands under debt capital. And these are the major two ways that has been used by a firm to finance its operations and investment. The equity is more of a plus to the organization, while the debt is a minus to the organization because it is not theirs. And what is the goal of capital structure? It's to maximize firm value while minimizing the cost of capital. And also, debt offers tax benefits but increases financial risk. And this is important to note uh, in capital structure. The debt offers tax benefits. However, it increases financial risk. Anything can happen, and this is really not a good uh, um, means of financing, though it is being used. It's not still a good means of financing the business. We have some theories that guides capital structure, and we'll be discussing about the net income theory, the net operating income theory, and the Modigliani-Miller training and theories, which is the MM theories. Um, the net income theory was propounded by David Durand, and that was also the person that did the net operating income too theory too. So the net income theory suggests that a firm can increase its value and decrease its overall cost of capital by increasing the proportion of debt in its capital structure. So it suggests that a firm can increase its value and decrease its overall cost. So a means of this decreasing overall cost and increasing value is by uh, increasing the proportion of debt in in a capital structure. So it assumes that debt is cheaper than equity due to the tax deductibility of interest. So he is agreeing with the fact that the use of debt um, capital is cheaper than that of the equity capital, and more debt lowers WACC and increases firm value. That if you borrow, if you finance your business using debt, it lowers the WACC and then increases the firm's value. And for the net operating income, just like I said, it is propounded by David Joran too. It asserts that the capital structure is irrelevant to the value of the firm. It argues that changes in the debt equity mix do not affect the firm's overall cost of capital or value. And you see it's contrasting the adoption of the debt capital as a means of actually forming a capital structure. And for theory, we see that it offers two major propositions, with and without taxes, and that further developed the debate on capital structure. And for without taxes, first proposition in 1958 without tax states that capital structure is irrelevant in determining the firm's value, and we see that it aligns with that of that of the veteran of net operating income also. However, for with taxes, it states that debt financing adds value to the firms to firm because interest is tax deductible, leading to tax savings. So he proposed that he propounded for that of with tax that the debt financing adds value to the firm because interest is tax deductible, leading to tax savings. These are showing a more of coming close to accepting that debt capital is getting better, is more better than equity capital because of the value it has on the firm, eh, despite the fact that we have some that are saying it's irrelevant in determining firm's value. But that of the tax also agree to the fact that it's add value to the firm because of the interests uh, is tax deductible and leading to tax savings. Um, Another important part is leverage. What do we understand by leverage? In financial management, leverage refers to the use of fixed cost financing sources, particularly debt and preferred stock, to increase the potential return on equity. And leverage magnifies both potential gain and potential losses, making it a double-edged sword in capital structure decisions. And there are two types of leverage, main types of leverage relevant to financial management. We have the operating leverage and we have a financial leverage. For operating leverage, it measures how a firm fixes operating costs, amplify the impact of sales changes on operating income, increasing both profit potential and risk. And the financial leverage reflects the use of um, debt to magnify shareholders' return when earning exceed borrowing costs, but also increases the risk of financial distress if earning falls short. Another aspect is the financial risk and its components. In discussing the capital structure, financial risk is very important. Financial risk is the additional volatility and potential insolvency faced by shareholders due to fixed debt obligation, which must be paid regardless of a firm's profitability. So it is the volatility and potential insolvency faced by such shareholders due to fixed debt obligation. You have a fixed obligation to be carried out, not minding the profitability, performance, the level of profitability of the organization. And these components, the components of financial risk are the fixed financial obligation, which is interest and principal must be paid regardless of earnings. Also, insolvency risk, which is the inability to meet fixed commitment due during periods of low earnings. And lastly, increased earning volatility, which is leverage magnifies income fluctuation for shareholders. What are the factors affecting capital structure? We have a number of factors affecting capital structure, and the first is business risk, which talk about high risk firm prefer equity to avoid distress, and that is why I said the other time that equity is is better than using debt risk. So for business risk, high risk firm prefer equity to avoid distress. And the second one is the company size and stability. So lighter firm borrow cheaper due to credit rating. So they borrow cheaper due to credit. So one of the factors affecting the capital structure is the company size and stability. Another is the control consideration, which talks about the equity dilutes ownership. The debt preserves control. And we have the tax consideration also. Debt favored for interest tax deductibility. Other factors include the cost of capital, flexibility, and future financing needs, the market conditions, industry norms and comparison, which these are factors affecting it. Others are also asset structures, also the financial distress and bankruptcy cost also. Major thing, the regulatory environment and managerial attitude and ownership structure. These are factors that affect capital structure. In conclusion, capital structure decisions are fundamental to financial management, and they determine how firm balance debt and equity to optimize financing costs. So maximize shareholders' value and manage financial risk. By integrating these principles all together, financial managers can make informed decisions that aligns financing choices with long-term sustainability and value creation. And the next topic we'll be talking about is dividend decision. Thank you.